Let's get right into it. Today, we're taking a mountain of incredibly dense, highly technical financial fact sheets and turning them into a clear, visual roadmap of the Indian stock market. If you've ever looked at the sheer number of stock market indices out there and felt completely overwhelmed, well, you're in the right place. This explainer is going to make total sense of how the market is actually structured, from the absolute largest players all the way down to the microcaps.
All right, here is our roadmap for today. Section 1 covers the Nifty 500 universe, then Section 2, the free float calculation. Section 3 hits large caps, the heavyweights. Section 4 is the mid-cap middle ground. Section 5 dives into small and micro caps. And finally, Section 6, mixing it up with multi-caps.
So I want you to think of the market like a set of nesting dolls. Our absolute largest foundational doll, the one that holds everything else, is the Nifty 500. Whenever we talk about splitting the market up into different size segments, this is the master list we are usually drawing from.
Section 1, the Nifty 500 universe. The crucial takeaway here is that this index captures the top 500 companies in the market. It acts as the primary eligible universe for, well, slicing and dicing. And getting into this club isn't easy. A company actually has to be ranked within the top 800 based on both average daily turnover and average daily full market capitalization, meaning their total overall value, over the previous 6 months. So this ensures we are only looking at companies that have significant size and genuine consistent trading activity. Section 2, the free float calculation. Now, across nearly all the fact sheets we analyzed for this, you're going to see the term free float market capitalization. Sounds complex, but it just means we are only weighing the shares that are available for public trading on the open market. It totally excludes locked-in shares, the ones held by promoters or the government, so it gives us a much truer reflection of what investors can actually buy and sell. Think of this whole process as a rigorous series of sieves. It's not just about being a massive company. You have to pass some strict liquidity tests. For instance, a stock needs to have traded for at least 90% of the days during the previous 6-month period. They literally have to constantly prove their relevance and liquidity just to get their foot in the door, let alone maintain their spot on these indices. Section 3, large caps, the heavyweights. Enter the Nifty 50. This is the most famous slice of the pie, holding the absolute largest companies and reflecting overall market conditions. For a stock to qualify for this heavyweight tier, it must have traded at an average impact cost of 0.50% or less. Essentially, that means you can buy or sell massive amounts of these stocks without artificially spiking or crashing the price. It is a fantastic measure for how highly liquid these mega corporations really are. But notice how incredibly top-heavy this segment is. Just look at those numbers. HDFC Bank alone sits at over 11%, and ICICI Bank is right behind it at 9%. This makes financial services the completely dominant force here, taking up over a third of the broader Nifty 100 large cap universe. Make no mistake, when these massive banking stocks move, the entire large cap space feels the tremor.
Section 4, the mid-cap middle ground.
Moving down a tier, the broader Nifty Midcap 150 captures ranks 100 to 250 in the overall universe, but even this mid-tier is filtered on further into a highly liquid top 50 group known as the Nifty Midcap 50. Here, preference is actually given to stocks that are available in the futures and options segment.
What's fascinating here is how the personality of the data shifts so dramatically. While financial services definitely still leads the pack, its dominance actually shrinks. The mid-cap middle ground brings in a much stronger showing from sectors like capital goods at over 14% and healthcare at over 10%. It's just a much more balanced slice of the economy. And when you look at the specific top constituents of the mid-cap 50, you see completely different names driving the performance. We've got BSE Ltd at the top with over 7%, followed by Federal Bank and Suzlon Energy. The usual mega-cap suspects are completely gone, replaced by these emerging powerhouses. Section 5, small and micro caps. Next, the Nifty Small Cap 250 takes the remaining bottom half of the Nifty 500, and it sits right alongside the Microcap 250, which steps entirely beyond the 500 universe. It really just goes to show that once you step outside the large and mid tiers, there is an absolute ocean of publicly traded companies waiting to be indexed. So it's a neat little numerical sequence. Ranks 251 to 500, that's your standard small cap 250. The second you hit rank 501, you cross over into microcap territory, going up to rank 750. But there is a crucial broader index here that a lot of investors constantly ask about, the Nifty Small Cap 500 Index. To be eligible for this specific ecosystem, a company has to rank outside the top 250, but still within that top 750 based on full market capitalization. It's calculated using that exact same free float method we discussed earlier, and you'll see this used heavily by mutual funds as the go-to benchmark for aggressive growth portfolios. Unlike the large caps, this index leans super heavily into sectors like industrials and consumer discretionary. The top constituents in this space are often acting as rapid growth disruptors in their respective fields.
Now, while the Small Cap 500 offers that massive, broad exposure, strict liquidity demands often pull investors toward the condensed Small Cap 50 subset. And this brings us to a highly fragmented space. Top companies here, like Navin Fluorine, hold just 3.72% weight. That is a stark contrast to the 11% giants we saw back in the large cap space. It basically means the performance of small cap indices is driven by a much wider, far more democratic distribution of companies, rather than just one or two behemoths pulling all the strings. Section 6. Mixing it up. Multicaps. For investors who basically want the whole nesting doll at once without letting large caps completely hijack the portfolio, there are structured blends. Indices like the Multicap 50, 25, 25 systematically mandate that exactly half your weight stays in large caps, while a quarter each is forced into mid and small caps. And these target weights are rigidly fixed and reset at every quarterly rebalance. Alternatively, with an equal cap weighted index, you can just throw out the market size bias entirely. This specific index assigns exactly equal quarterly weights to the large, mid, and small segments. It's honestly a fascinating way to ensure that the massive heavyweights don't drown out the performance of the smaller, high-growth challengers. Understanding how these benchmarks are built is quite literally the blueprint to understanding your own investments. Whether it's the high liquidity of the Nifty 50 or the broad diversification of a multi-cap strategy, the data reveals how every single tier operates under its own strict set of rules. Which leaves us to wonder, based on this breakdown, which slice of the market are you going to focus on next?